Hey everyone, welcome back to the channel. Today we're diving into the latest updates on President Trump's big, beautiful tax bill, officially known as the One Big Beautiful Bill Act. This is a massive 1,116-page proposal that's making waves throughout Washington. You're probably hearing about it, and I'm here to break down what it means for you, your wallet, and the economy by giving you the top 17 tax highlights specifically for investors. So let's get into it. First, please, if you like this type of content, subscribe if you can. Give me a like if you can. It really helps our channel out. All right. The big, beautiful bill aims to extend and expand the 2017 Tax Cuts and Jobs Act. And here are the top 17 tax provisions. Number 1 is permanent tax cuts. It extends the individual tax cuts from the 2017 legislation, preventing a potential tax hike for many Americans. The 12% would go to 15%. The 22 would go to 25. The 24% bracket would go to 28, 32 would go to 33, and 37 to 39.6 if this act is not passed. Right now, all of those provisions at the end of the year would revert back to the higher amount, which is not what you want. That's more taxes for everyone. All would stay at the lower amount if this bill is passed, and this is very significantly. That's the big one. Number 2, standard deductions. Under current law, in 2026, the standard deduction for singles would be $8,300 and probably $16,300 for married filing jointly. This is your standard deduction. These go to $16,600 and $32,600 from 2025 through 2028. It's doubled. It's huge. Big difference. For seniors ages 65 and older, this is an above-the-line $4,000 deduction per eligible filer with a modified adjusted gross income that does not exceed $75,000 for single, or if they're married, I think it's $150,000 if you're married filing jointly. The senior deduction is available to both itemizers and non-itemizers. That's why it's called above the line. The deduction would be allowed from 2025 through 2028. So that was number 3. Number 4, it's the termination of the deduction for personal exemptions. Current law right now, the deduction for personal exemption is set to return after December 31st, 2025. What this does is it says it's gone because we have the increase in the standard deduction. So that's going to go away. Number 5, and this is big for your real estate investors, it's a Section 168 bonus depreciation. Current rules make it so you write off the cost of property, for example, real estate, over a period of years, sometimes 27 and a half years, 39 years. The bill proposes making the 100% bonus depreciation available from January 20th of 2025 through December 31st of 2029. This is great for real estate investors who know how to use cost segregation. This is one in particular that I've had my eye on for a long time. And a lot of people, especially you syndicators out there who love to have losses get flowed down to your investors so they can offset their other real estate gains. This is huge in that realm, although it addresses any property that, again, anything under, I think it's 20 years, would be 100% bonused in that first year. You can elect to do that, or you could spread it out over a period of years if you wanted to, but that is a huge one for those of us who are real estate investors. Number 6, this is a limitation for qualified depreciable property deductions under Section 179. This is, again, things like equipment. The deduction limitation from qualified depreciable property as business assets is increased to $2.5 million, up from the $1 million amount. The phase-out threshold is raised from $2.5 to $4 million. In English, what this means is that if you're not going to use 168 because maybe for state taxes your state doesn't recognize it, you could use Section 179 and it might be more advantageous for you. And what this does is it increases the amount that you can deduct. And these things are great. If you ever look at the tax foundation or look at the analysis on it, these things are huge increases to our GDP and to our economy as a whole. These are provisions that specifically 168 and 179, guys like me have been talking about it for years, saying, why are you forcing a company when they invest in assets or in equipment and improvements and in real estate, why are you making them take that deduction over such a long period of time? It's short-term thinking. If you incentivize them to invest in these things, they will, which creates more economy, like increases the GDP. And that's been proven over and over and over again. So thank God these things are in there. All right, number 7, miscellaneous itemized deductions become their exclusion becomes permanent. They were set to return in 2026. The limitation caps the value of itemized deductions to 35% of each dollar as well. So if you're somebody who's in the top bracket, this may hit you. It's not going to hit any like regular folks at all, but this is a huge one. Again, miscellaneous itemized deductions went away. Now they're gone. They're permanent. They were coming back. Number 8, limits that were permanent that were set to expire on December 31st of this year and come back in 2026. Here's the ones that are now permanent. The mortgage interest limitation is $750,000. It used to be $1 million before the Tax Cut and Jobs Act. Now this is going to be permanent. Casualty loss limitations, unless it's a federal emergency, I believe that you're not going to be getting it. There's been issues over this one a lot, but they're going to make it permanent. Bicycle reimbursement exclusion is now permanent, gone. Moving expense deduction is gone unless you're active military. Wagering loss is still limited to wagering winnings. All of those that were set to come back on January 1st of 2026 are now permanently gone. They made it permanent. Number 9, the SALT deduction cap increase. This is a big one. You're hearing a lot about it because people that are in a high tax state are where it's state taxes are mad because they're limited to writing that off only to $10,000. That includes property taxes, right? So if you're somebody and you had a lot of state income taxes, then you weren't really getting a huge tax benefit. And there's a lot of people that say, well, why would we subsidize a state that's taxing the heck out of it and using that money for themselves? Why would the federal taxpayer, why would somebody in another state have to help that? But you're seeing this as a big one for those Congress people that are in states that have high income tax. Because under current law, in the case of an individual, the itemized deduction for state and local taxes is capped at $10,000. And that is actually set to expire in 2025. So the cap goes away. The SALT deduction cap is made permanent and raised to $30,000 under this bill. The cap would phase down by 20% of the excess of your modified adjusted gross income over a $400,000 threshold until it goes back down to that $10,000. So for rich folks, you're making over $400,000. The more that you make, it's going to phase down. So it sounds like probably about $100,000. It would phase back down to that $10,000 limit. If that made your head spin, I'm sorry. It's just, if you live in a state that doesn't have a lot of state and local taxes, you don't have to worry about this. But if you are one of those people that has been missing out on this, at least they're talking about making it substantially more, 30,000, and I've heard all the way up to 90,000. Keep your eye on this one because this is what will keep it from getting passed sooner than later and may push this whole bill out as far as these guys wrangling over that one provision. All right, big ones for regular folks. Number 10, no tax on tips and overtime. So this bill would eliminate federal income tax if you make less than a certain amount, 160,000, I believe is what it is, on tip income and overtime pay, benefiting service and industry and hourly workers. These are both going from 2025 to 2028. So this is not a permanent provision. It's going to be from 2025 to 2028. So it's like here's a temporary incentive probably to get this thing passed, especially in states like where I'm standing right now in Nevada, where they get very excited about not having to pay tax on tips because we're the state with the highest amount of tips, if I'm not mistaken. Like the amount of revenue that's generated off of tips here in the service industry is pretty massive. So that would be a boon for my local area, right? And so that's a big one for folks that are in those service industries. Number 11, this is a new one, deductions for car loan interest. And this allows deductions of up to $10,000 of interest payments on car loans from 2025 through 2028. These deductions are allowed for automizers and non-automizers. In other words, it's an above-the-line deduction. You get to write this off whether you're using your whether you're itemizing your deductions or not. So you can take the standard deduction plus you can still write this off. This is huge. This deduction phases out for single taxpayers earning over $100,000. Married filing jointly, double that to $200,000. It starts to phase out. And then what does it include? Two wheels or more assembled in the U.S. vehicles, including RVs and sounds like motorcycles. And I think even some off-road vehicles would still qualify. So if you're financing these, this is something that you're going to want to pay attention to because you get to write off that interest, whatever you're paying. And by the way, auto interest is a huge issue right now because we have so many defaults. I think it's going on historic highs right now of defaults on those auto loans. So this is perhaps a solution to help get some relief to those folks that are suffering underneath maybe some high interest rates. Number 12, health savings accounts, HSAs. Under current law, statutory HSA contribution limits are indexed every year for inflation. So in 2025, the annual HSA limitations are, I think it's $4,300 for an individual. For a family, I think it's $8,550. So what this provision allows individuals who make less than $75,000 annually, or in the case of families, $150,000, to contribute an additional $4,300 or $8,500. Basically, it doubles it. That's my understanding. There's a little bit of misinterpretation because, I mean, very clearly this is what it says in the bill, but I'm not certain this is what I thought that they just wanted an increase. But it looks right now that you could double that amount, which is pretty significant each year, that they could contribute to their HSA index for inflation. So it's going to keep going up. Such additional amounts are phased out for individuals making over $100,000 annually or $200,000 for families. So again, if you're making too much money, these things phase out. Also, this is huge, for sports and fitness. So a fitness facility membership fees, they're typically not treated as qualified medical expenses. But this provision would allow individuals to use their HSA for physical fitness memberships and instructional physical activity up to $500 per year for an individual, $1,000 per year for a family, with up to 1/12 of such expenses allowed per month. Let me explain that in English. So if you're only doing a membership for 6 months, then you're allowed to take the amount of the expense would be amortized over a year. So if you paid $500 for the next 12 months, but you're 6 months into the year, you're only going to write off half of that. So you're going to write off $250,000. But this is pretty exciting because normally you don't get to write off gym memberships and things like that. This would allow us to contribute to an HSA, deduct it, and then use the HSA to reimburse that, making it deductible. We actually like that. All right, number 13 is Section 199A. This is a big one. This is a deduction for qualified business income under Section 199A, and it's increased from its existing under the Tax Cut and Jobs Act. It was 20%. By the way, this was set to phase out, and this is going to be permanent. So if you made $100,000, for example, as a sole proprietor or as an S corporation at Flowdown, you would only have to pay tax on 80%. Now that's going to be, you're only going to have to pay tax on, get this, 77%. So it's a 23% deduction. This is for flow-through businesses such as sole proprietors, partnerships, and S corporations, not for C corps. C corps got that, you know, the flat tax rate, the corporate tax rate, and that's not going anywhere. That was permanent when it was passed, and so this is what they gave to the flow-through. There are still phase-outs for certain types of business. So there are specific types of businesses like law and accounting and medical and some of the arts and things like that where you start to phase out. The rest of it, there is a phase out, but there's a W-2 calculation. I'm not going to get into all that, but it makes the 199A deduction a little bit greater at 23% and permanent, which is big. All right, number 14. Some of you guys get hit by this one. It's the excess business loss limitation. The limitation on excess business losses for non-corporate taxpayers is made permanent now and are carried forward to future taxable years. The maximum amount of a business loss taken in a year is based on an inflation-adjusted threshold. So I think it was $313,000, and for single, 626,000 for joint filers in 2025. That's going to keep going up, but that just means that you have a limit. For example, if you're using cost seg and you're trying to wipe out your W-2 income, this is the limit that says here's how much maximum you can take for a year. If you exceed that, then it flows into the next year. You just carry it forward. So that's going to make that permanent, which is great. Number 15. Or I shouldn't say it's great. It's like they're making it permanent. Personally, I don't like it because I'd rather be able to write it all off. But that's horse trading with Congress, right? Number 15, opportunity zones. They're reestablished. So this is going to be a second round of opportunity zones. So if you're somebody who likes those opportunity zones, there was a second round is going to be established for taxable years 2027 through 2033. So it's not right away. Remember that the opportunity zones keep going on, I think, through 2026. So the next year where we have to worry about it is actually 2027. So this is making it consistent. I don't know how they're going to treat step up and basis like they originally gave us, but it would be, they're basically new opportunity zones that are between years 2027 and 2033 with similar but modified benefits and temporary deferral of capital gains taxes, a step up in basis and exclusion of taxable income on new gains. Right now, it's if you hold it for 10 years, and I believe it's going to be identical. So this is just another round. So all of you Opportunity Zone fans, you're going to get another bite at that apple, which is pretty significant because, again, there was a lot of funds that were created to take advantage of that. It's lost its luster since there's this step up in basis that phased out after a few years. And this is going to bring it back in, actually 5 and 7 years technically. So this is going to bring it back in. The enhanced child tax credit is number 16. It increases the child tax credit to $2,500 per child for tax years 25 through 28. So 2025 through 2028. This is great. That tax credit would go up to $2,500 and stay there. And then number 17, they have these new mega accounts that are established as a $1,000 savings account for children born during Trump's presidency, which is, 1/1/24 to 12/31/2028. In order to be eligible for this, I think the child just has to be a U.S. citizen, but both parents have to have work eligible Social Security numbers. So, and if they don't, by the way, there is a safeguard where you could still apply for it, and the government would set up an account with this $1,000. But remember, this is not law yet. None of these. This is just a proposal, and this could take through the end of the year to get passed, knowing how contentious lawmakers are right now. So this could be a bit, but this is what the big, beautiful bill is showing us from a tax standpoint. Now, I just gave you highlights, and it's more for individual. There's lots of provisions in there that address things like the GILTI tax, a lot of the international stuff, plus other things. But for our purposes, I'm focusing on what helps us as individuals and as investors. So I hope you found this valuable. Like and subscribe, and please share this with anybody that you think would benefit. And if you could, in the comments below, let me know which provisions are most important to you. It's always interesting to see what are the provisions that people really care about. And I'd be interested to hear from you as to what provisions you think are most important. Maybe your top 3. That would be great. Thanks, guys. See you later.